Dear professors and students, the Accounting and Finance Society has the honor to present Mr. Panagiotidis. Georgios Panagiotidis is financial and human resources manager at PLAYMOBIL class. His first job was with Arthur in Germany, and after returning to Greece, he worked among other companies at Deree, as Deputy Chief Financial Officer. Mr. Panagiotidis studied business administration at the University of Bayreuth, Germany. He majored in corporate finance and banking, taxation, and at the University of Leeds in the UK, majored in economic studies. He is General Secretary of the Hellenic Institute for Financial Management of the Hellenic Management Association and member of the American Hellenic Chamber of Commerce Taxation Committee. He is a full member of the Association of Chartered Certified Accountants ACCA, member of the Hellenic Economic Chamber, and in his free time he engages in yacht sail racing and has been a member of the Optim yacht racing team for 10 years. Mr. Panagiotidis, the floor is yours. Thank you.
Thank you very much. Thank you for your invitation. It is quite early in the morning, so I thought we would do it a little bit light. So I have chosen the credit default risk, which should be easy for everybody. Almost everybody understands what it is, but maybe has not gone in depth until now. So we'll have a quick look at the comments. We're going to firstly look at the risk management side of the default risk. How do we approach the whole thing? After that, we're going to have a look at some theoretical background and at some current issues. Quite interesting, I believe. Now, the risk is quite obvious. I have a customer. He purchases the merchandise on credit. That means he does not leave cash behind, but our company is left with an account receivable. So the risk is that we will not receive the money. That means the customer or the borrower will default if he fails to make a payment of either the principal or the interest. It depends. Some of the agreements do not have interest payments. So if he does not do it on time, then we have a default event. Now, we have to manage this risk on a daily basis. This is an operational risk. As with all risks, we first have to go on and identify where this risk is in our company. It's quite easy. After that, this is the part where it is not so easy. We have to go on and assess it. By assessment means we should take a look at two things. We should think about the likelihood of this happening. That means the likelihood of our customer not paying on time or not paying at all. And the other thing we should think about is the impact that this default event would have on our company. These two aspects are very, very important. It is actually the assessment of our risk. Having done so, we go on and control it and monitor the whole process. Very important for all the risk management and for the management of the credit default risk as well is the strategy, the risk strategy. Now, quite easy if we take a look at this table here. Now, what this table tells us is if we have a risk which is very, very likely to happen, and if it happens, it has a great impact, don't take the risk. Simple as that. I think it's very straightforward thinking. If we have, for example, to put it in a credit default situation, a customer who requires a very, very large quantity of, let's say, merchandise, but has suffered or has been suffering losses which is evident from the published financial statements, then, well, think about it, it would be a great impact, and the likelihood that he will not pay may be very, very high. So after the risk assessment, you are going to place the risk somewhere in this matrix. If you're in the upper right corner of this matrix, you should think about it not twice, but maybe don't think about it at all. Well, this is the easy part. Not so easy when you have a low impact and a high likelihood, or a high impact and a low likelihood. An example here. As before, big quantities required, obviously a very good deal for the company, maybe high margins are involved, very nice. Also the company, the potential customer, very, very sound financial status according to the published financial statements. Maybe he's listed. Okay. We should think about transferring this risk. Now this is what we do at our company. We try to transfer it, meaning we try to ensure that we pass the risk on. We come to this later on. Well, this sounds easy as well. What about if the likelihood is high and the impact is low? Thinking about customers who, well, do not require very, very large quantities, small quantities, and sometimes they, well, okay, obviously not listed companies, not available financial information, and, well, you get maybe a good rating from agencies which offer business information like ICAP, Dun & Bradstreet. Now, here we have to set lots of controls. We will go on to this later on. Now, very, very low likelihood and low impact. Well, the theory tells us maybe you shouldn't do nothing at all. We'll come back to this option later. What is the impact of a credit default occurring? That means our customer does not pay, the borrower does not pay the lender the money he owes. Now, obviously, the first impact is, or could be, that the profits are severely affected. If the customer is large enough, the company of the lender may suffer losses as well. Apart from this, we have an obvious cash flow problem. That means, because of your customer failing to pay you on time, you are not able to pay your supplier on time. This is something that has been happening in the Greek economy quite a lot, unfortunately. Part of it is because of poor risk management regarding the credit default. Now, we should not underestimate the impact, even for smaller quantities and smaller accounts receivable. The reason is simple. You may have gained a competitive advantage. That means that you have built a very, very good, let's say, sales channel, have very, very good relationship with your customers, and part of this good relationship is obviously that you can guarantee them a product which is not subject to obsolescence, which sells very good, and good margins which they can really budget and be sure that they will receive it. If you're going to suffer severe losses from credit default, that means you will have a spillover effect to your good customers, because it is an operational cost. You cannot afford to give the same margins as before. That means you may jeopardize your hardly earned competitive advantage. Now, don't underestimate, let's say, also the strategic aspects of this. Having said that, let's go to a real-life example. In real life, what we do is we use everything that is available. As simple as that. Use everything you can is, well, what everybody does, if he wants to manage this risk. Now, key issue in this risk management procedure is obviously the information. You should be able to gather the available information and systematically prepare it in order to be able to use it effectively. Many times there is information available in organizations, however, not systematically prepared, and when the person who takes the decision to give the credit or not, if this information is not available, then obviously the risk management procedure is not optimal, which may increase the risk of default in our case. Also very, very important, information asymmetry. The so-called levels problem, you should always assess the information you have. You should always be aware of the motivation of your counterparty, of where this information is coming from. As I said before, the easy part. We did a company, it is actually global policy, transfer it. Well, easy job for me. All we do is pay this premium to the insurance company. Well, everybody's happy. There are some companies who do that. Well, maybe this sounds peculiar, but there is actually a company which can offer you insurance for the fact that your customer does not pay. Well, you can do it. Obviously, it is a little bit complicated, but we keep it simple. Everybody smiles, happy. What is the problem? It does not apply to everybody. Unfortunately, this applies only for the good customers. Remember, in our metrics, likelihood is low. We are talking about financially sound customers, where you would probably be thinking, well, great impact, but let's say big listed company like that will never go bankrupt. Well, maybe so, but you can never be sure. And in recent economic history, we have seen that, well, unfortunately more than one time, that even big companies can fail. Now, the second and maybe more disturbing problem is that your business partner may decide to discontinue the service, either completely or with a specific customer. That means you have an insurance company that says, all right, the Greek exit from the Eurozone is a risk I cannot handle, understandable, decides to exit the Greek market. It's not a theoretical example, we're talking about real life examples. Has happened with Kofas in 2012, caused us a lot of trouble, but we managed it correctly. We went on to a local insurance contract with another company, with Euler Hermes. Obviously because of the limited diversification of the portfolio, a global contract for credit insurance has much better credit risk premiums. That means, okay, we had to pay more, but we covered the risk by transferring it to an insurance company. The treatment, the overall approach is, you have to really analyze the business, your own business anyway, but the business of the customer. analyze the cash cycle. Finance your business, take into account all seasonalities, and this is the first step towards a good risk management regarding the credit default risk. Having done so, you should go on and analyze every single customer and see if he is creditworthy or not, and if so, for how much money. Also very important, you will not want your customer to go over trading. Now, after that, adequate credit policy. Every customer has, let's say, the right, if he has a good financial situation, to get financed for your business, right? He is being financed to sell your goods. Now, it is very important to actually understand what we said before, the cash cycle, in order to form the adequate credit policy. The last step, but it is also very important in organizations, in companies, you have to put on the controls which are necessary to make sure that this procedure is being followed. Now, when we treat a risk, we introduce controls for two things. The one thing is to reduce the likelihood, and the other thing is to reduce the impact. It is these two aspects which have to be taken into account while treating a risk. Now, first step we did is we built a database with all credit default events. That means even a late payment was recorded in this database. Very important is to have a good picture of what this default event was about. It is not the same if the customer has paid with a delay of 1 week or has not paid at all, and you actually have a lawyer trying to, well, minimize the loss cost. Key issue, as we said before, information. Well, let's face it, we are back office of the sales. That means that the frontliners have the best information that is available in the company, which has to be used by you in order to correctly, or let's say, not correctly, but to best face and treat the risk of credit default. They speak with the customer, they know the customer, they see the customer, they know soft facts about him, they know his personality. Very important issue when dealing with this. Now, you could also go ahead and develop some sort of qualitative scoring model like Argenti's A-score. Well, maybe you don't want to do something as competitive as the A-score, but in the correct direction. That means give your sales team or everybody else who is involved in this procedure, well, let's say a list of questions which they can answer, and so you gather the necessary qualitative information for your customer. Now, also very popular, businessman. Well, didn't go well. His first company or his second company goes bankrupt. What does he do? New company. Fresh start. Very important information not to miss. This part when you're assessing the risk for a new business relationship. Well, unfortunately, the past default experience is very, very important, because people who are not, let's say, paying on time will do so in the future as well. I have seen it many times, but it is also very important that people who left you with bad debt will not come and receive a fresh credit. Now, obviously you can pay money and receive more information. That's what you should do. You should use all the available resources. And I mentioned it before, an international term or firm is Dun & Bradstreet. Obviously, ICAP is one of the key players here. And as that, there are well some companies who offer business information. Well, as a company, maybe you don't have the resources or you don't want to use up the resources, for example, for gathering published financial information. Right? These guys do it for you, you pay them, you receive the information. It is very important to have this information in your risk management model. For larger customers, you can also have a rating either from S&P, Moody's, or other organizations. Small customers who are not listed and obviously do not have a rating from either S&P or Moody's, well, you can ask them for their financial statements or for other information you consider useful for assessing the risk, right? We are, remember, trying to reduce the likelihood. That means the better the financial status of your potential customer, the lower the risk that he will default on payment. All right, now, you could also apply a Z-score or a modification of it. There are some problems with this approach, so we may talk about this later on. Now, how can we reduce the impact? The first thing is, remember, the impact was, well, reduction of profits. Since the credit default is risk, which is an operational risk, should be priced. It should be included in your pricing. Now, in case you don't have the possibility to insure the customer or insure for the whole amount, let's say you want to do business for a couple of millions and you receive insurance for 1 million or 1 million and a half. Set limits according to the different levels of management in order to, well, let's say, minimize the impact, making sure that, well, there is not a potential risk of $1 million which has not been taken into account by, well, the upper management. Straightforward, reducing the days will lead to lower accounts receivable, lower outstanding amounts. That means there is another way to reduce the impact. However, as said before, you have to give your customer a realistic chance to pay you on time. This is a win-win situation. It will not make sense not to finance your business and ask for your customer to pay you in 1 month. He probably won't be able to do it if he has not sold the goods. So why not give him 2 months, receive your payment on time, and everybody's happy. But obviously you have to be sure you're not, we'll say, granting 190 days, 180 days, if he only needs 90. Very important, build a reserve. This will lower your impact. Right? Traditional finance thinking means prudence, but also the matching principle. Right? We can come back to think about what IFRS tells us, what the statutory gap tells us regarding the treatment of the bad debt provision. The tax, obviously the tax authorities have their aspects. Well, bottom line, if you build a provision, it helps you a great lot to deal with the credit default event. Terminate. Well, this is an option. As mentioned before, if it is outside your risk policy, don't make the deal. Simple as that. If he doesn't want to pay in cash, no deal. A bank guarantee could also be accepted. Maybe this is actually passing, this is transferring the risk, but terminating it should be an option if the risk is too high. Never tolerate the credit default risk, right? It's easy, right? You see here, to-do list, nothing. Well, unfortunately, not an option for us. To sum it up, there is a risk, you have to manage it. You cannot go around managing this risk, as is with all business risk. Receive the information you need, look at the pricing, and be prudent and match your income with the cost, with the operating cost. Will do the job. Some of the current issues are really obvious. We'll skip that. We'll go to the fact that now we have actually started rethinking that a credit default risk may occur at us as individuals or as companies, while our bank is actually what we thought safe at the bank or somewhere else. Now, you should always know and maybe also diversify. If you're going to have a cash pooling system, you should diversify and look at the other way. Look the other way around. Not always, not banks. Banks are not the only ones who face this risk of defaulting. Banks had unfortunately defaulted in the past as well. So we have gone away from the thinking too big to fail. So you should take into account this as well. Regarding the treatment, as I said before, in pricing we have to take it into account. So the question is, how do we actually calculate the impact and how much we can price this in our product? Now, the potential loss has to be taken into account. There's either, when the default occurs, there is two things that have to be considered in order to calculate the expected value. The one is the probability of the default occurring. This has been calculated by you, or let's say assessed by you when you assess the risk. And in case of default, how much can you recover? It's very important. If you have these two, let's say, variables, you can actually calculate your potential loss. We have an example prepared for you. Now, I'll go through this a bit quickly. The main thing you have to understand, maybe from your other curriculum, other syllabus regarding probability, is that there is a volatility regarding the assets. And we can actually define default as the situation where the value of the assets falls below the value of the debt. If this happens, we have actually the case of default. Now,
Mr. Panagiotidis, so should I recommend that we allow some time for the audience to address any questions to you?
yes.
Is it going to take long enough? Because maybe you can give it to Dr. Coaches as guest study for the classroom, for the students. If you think we can discuss it, of course.
I will need a couple of minutes to make a point through this example, and in 5 minutes I will have finished, and you can make questions if you want. It is very important to understand that there is a volatility, and this volatility plays a crucial role in how to price, how to include the credit default risk in your pricing. Now, what we need to do is to calculate how probable the default is. Well, lucky enough, there is a model which gives us this, let's say, estimate. The bottom line of this is that you need to make some assumptions, you need to do some math. This may not be 100% accurate, but it leads you to, let's say, assuming a normal distribution, calculate the probability of default. This is the default probability for 1 year in the example we had. Now, having done so, we are able to calculate what the default spread is. Now, this is the point I would like to make. We should keep in mind that in pricing, you should have a default spread. Now, here we have it for an interest rate. It is actually the same procedure, the same approach if you are pricing something else. There is controversy regarding interest recognition. As you know, if you pay an annuity to the bank, the most part of this payment is for interest. Interest is income. But the problem is that, well, this income is front-loaded. And if the company, let's say in this case the bank, will not be prudent enough to build a reserve for this default risk, then you will have ended up with a great imbalance in the time between income and the risk. At this point, I would like to summarize. We have to manage the risk. We have to maintain reserves, sufficient reserves to cope with the actual defaults. Understanding the theory helps us to take into account all aspects and how to deal with those. And finally, we have to correctly evaluate our accounts receivable in financial statements in order to be able to truly evaluate it. That's about it. Thank you for your attention.
Thank you very much. It was a crucial point after all. Thank you. So, do we have any questions? Yes, one.
Thank you very much for being here, Mr. Panagiotidis. I have two interrelated questions, actually. The first is, in the context of firm value generation, creation, how important is working capital management and optimization for a firm, especially in terms of price, in condition of pricing, for example, 2008, 2009, and to some extent now. Second question is, in the context of crisis condition, how do you actually optimize working capital to make it robust to these conditions?
How do you
optimize working capital? How do you manage the crisis condition?
Yes. So it's also working capital related. This is a very good question. As you have seen from the impacts, the working capital will actually be affected by default because it will keep it high, right? Because you will not collect the money, you will not, let's say, finish the cash cycle. How do we do that? Well, this is exactly what we have been discussing about. If you have been managing it correctly, then you may reduce the risk. Now, as a matter of fact, we have virtually reduced our impact to zero after PLAYMOBIL, but have not stopped financing the business. Now, this is actually a very good point. This was actually the working capital management. We tried to finance only our part of the business. So what we're talking about is the cash cycle, right? You have the product, then you have the receivable. You have to make sure that you will receive cash in a timely manner. You should go and form your credits, let's say your policy, in order to receive the cash not too early, but also not too late. Calculate exactly how much your business needs, or your customer needs to cash in the money, and then go and take it. This is actually the only simple but effective idea that you can think about. The other thing you should also not underestimate is if your customer defaults regarding other suppliers, then it is a matter of time before he defaults on you. So this is why you have to gather information quickly in order to maintain, let's say, your working capital at the minimum level.
Thank you very much.